Notes 1, Question 1 asks, what is the goal of financial management? How does it differ from the goals of other business areas like accounting, economics, etc.? The goal of financial management is to maximize the shareholder's wealth, the portion of the shareholder's wealth entrusted to the company and under manager's stewardship. This differs from other goals such as accounting goals of compliance with generally accepted accounting principles or IFRS and accuracy of the accounting process, the goal of economics of profit maximization and the sales maximization from marketing. Question 2 asks, why can financial management be considered a general management model rather than a specialty business area? Financial management's goal is to maximize shareholder wealth, which encompasses many different managerial functions within the firm, rather than having an objective or objectives that are more specific to a particular managerial function, such as human resource management, operations management, supervisory management, marketing management. The shareholder wealth maximization goal depends on all management tasks in the firm and their integration with one another. Therefore, financial management is more of a general management discipline. Question 3 asks, how is shareholder wealth measured? Well, shareholder wealth refers to the value of the shareholder's investment in the firm. Since a market exists for ownership shares in publicly traded corporations, this is equivalent to the value of the firm's stock, especially if the stock price is frequently traded. Thus, the market price is usually very current. Question 4 asks, how does an agency relationship differ from an agency problem? Well, an agency relationship exists any time an agent is hired to serve the interest of the employer. A customer hires a mechanic to repair a vehicle. An individual hires an attorney to represent their interest in legal matters. All of these are agency relationships. In the case of professional managers, the principal, or the shareholders, employ agents, or managers, to run a company. This does not, by itself, imply an agency problem. As long as the agent does the best possible job for the principal, no problem. But if the agent starts serving their own interest at the expense of the principal, that defines the agency problem. Question 5 asks, what are the advantages of the proprietorship form of business organization and the disadvantages? Does the partnership form solve these issues? Why or why not? Proprietorships are easy to form and flexible because of their simplicity. They avoid the taxation penalties of C corporations. The disadvantages are that the business and the owner are one and the same. There is no limit of liability, and if the owner dies, then the business ends. Proprietorships also have limited access to funding sources. They can't issue stock or bonds in public markets to raise capital, and lenders are often cautious in their commitments to proprietorships since limitations of liability are not present. The owner's private assets are at risk under this form of organization. A partnership solves some issues, such as continuity of the business if one of the owners dies, but the firm still has to be essentially reformed. And there is a possibility that some owners can take on different roles. One owner could run the firm, for example, while the others are just capital contributors. This would be a limited partnership. Question 6 says, what are the advantages and disadvantages of the corporate form? Why do we concentrate on the corporation for this course? The corporate form usually separates the management and ownership functions. This represents a greater likelihood that professional managers will be hired to represent the interest of owners in running the firm. Corporations have limited liability, ownership is easily transferred via stock sale, and public corporations have greater access to capital funding than partnerships or proprietorships. This course concentrates on the corporate form because the typical investor interest in the firm is based on the risk-return complexion of the company. This allows us to develop effective decision models, and because corporations are prominent in hiring business school graduates for professional management positions, we do concentrate on the corporate form. Question 7. Maximizing the value of the firm should be the objective of a financial manager. Is this statement consistent with the argument presented in the notes? Why or why not? It is consistent with the shareholder wealth maximization goal, since the wealth of the shareholder is the value of their shares, the value of the firm. If effective maximizing management techniques are employed, then investors are likely to look favorably on the firm's shares as an investment. The greater their demand for the firm's shares, the higher the stock value would go. Of course, other factors do affect stock value, but the factor of greatest interest to the managers is the effects of their own decisions on the shareholders' wealth, and therefore the stock value and the firm value. And question 8. Suppose a conflict of interest occurs between shareholder interest and management's interest. What would deter this from happening? If it has already occurred, what could be done about it? Well, there could be compensation plans tied to firm performance, monitoring, and even major shareholders' influence can deter conflicts between shareholders and managers. If conflicts have already occurred, then the manager could be fired, or the firm could actually become a target of a hostile takeover, or lawsuits could be filed against the manager if sufficient evidence could be collected.